When delving into the price movements of gold over the past, we uncover intriguing patterns that shed light on its behavior during times of crisis and market turbulence. During this time, gold has often experienced initial declines before rebounding strongly. Let's examine the examples, but before we do that, let me say I am not a financial advisor. Let's begin. The collapse of Lehman Brothers in 2008 reverberated throughout the financial markets, triggering widespread panic. In the initial phase, gold prices declined as investors scrambled to liquidate assets, striving to cover losses and fulfilling margin calls. However, as central banks responded by implementing measures like quantitative easing and lowering interest rates, the tide turned for gold. It began a resolute rally that spanned from 2008 to 2011, catapulting gold prices from around 800 to over 1900 per ounce. Turning our attention to the recent COVID 19 pandemic, we find a parallel pattern emerging. As uncertainty and fear crippled the markets in the early 2020s, gold initially experienced a drop in prices. The crisis unfolded and markets crashed, sent shockwaves. Yet, once again, central banks took swift actions, slashing interest rates, injecting massive stimulus packages, and restoring the quantitative easing. This ignited a remarkable resurgence in gold from mid 2020 to 2021. Gold prices surged from approximately 1500 to over 2000 per ounce, captivating the attention of investors worldwide. Another prominent instance in history is the Asian financial crisis of 1997. As the crisis unfolded, numerous Asian economies faced severe currency depreciations and economic instability. During these periods, gold experienced a substantial initial decline as investors sought liquidity and sold their gold holdings. However, as the crisis deepened and confidence in the currencies waned, gold staged a strong recovery. From 1997 to 2000, gold prices surged from around 300 to nearly 600 per ounce, demonstrating its ability to act as a safe haven in turbulent times. Another notable event was the dot-com bubble. Its burst in the early 2000s as the euphoria surrounding internet-related stocks faded, markets plummeted, leading to a decline in gold prices. However, as fallout from the burst continued, accompanied by geopolitical tensions and slowing global economies, gold regained its luster. From 2001 to 2003, gold prices climbed from around 250 to over 350 per ounce. Moving further back in history, the oil crisis of 1970s served as an illuminating example. The sharp rise in oil prices triggered the economy shock, high inflation, and geopolitical tensions. Initially, gold prices saw a decline due to liquidation pressures as investors faced economic uncertainty. However, as inflation accelerated and confidence in the fiat currency eroded, gold emerged as a trusted store of value. From 1970 to 1980, gold prices skyrocketed from approximately 35 to over 800 per ounce, reaching record heights at the time. Now, when we consider the perspective for the next 5 months, I present a base case scenario that diverges from the recent historical trends. I suggest that gold may actually trade lower. This projection states from the observance historical tendencies of investors liquidating gold during crisis situations to address immediate funding needs. As I highlight, as a highly liquid and tradable asset, gold becomes a natural choice to meet such demands. However, it is important to note that I am also emphasizing the long-term outlook, anticipating a substantial rise in gold prices over the next 3 to 5 years. Above all, it is crucial to understand that gold holds a dual role. It's not merely an investment, but also an insurance. Its value lies in safeguarding wealth and providing a hedge against potential economical uncertainties or crises. Regardless of its current price, owning gold is considered a prudent strategy to weather turbulence. These examples highlight a recurring pattern when gold experiences initial declines during crisis driven by investors liquidating assets to cover losses or meet immediate funding needs, followed by going up. However, as the crisis deepens and central banks implement measures such as lowering interest rates, injecting stimulus, or engaging in quantitative easing, gold often begins a robust recovery. Investors turn to gold as a safe haven asset, seeking protection from economic uncertainties, inflationary pressures, and currency devaluations. While these historical examples provide valuable insights, it is important to remember that each crisis is unique, influenced by various factors such as nature of the crisis, policy responses, and global economy conditions. Predicting the future price movements of gold remains challenging, as it is a subject to a complex interplay of geopolitical events, monetary policies, supply and demand dynamics, and investor sentiment. Nonetheless, accurately predicting the future price movements of gold remains a formidable challenge. It involves considering a multitude of factors, such as interest rate, geopolitical events, inflation rates, and market sentiment. While the examples discussed offer valuable insight into historical trends, they should not be regarded as foolproof guarantees of prices, indicators of future prices movements. As we embark on this captivating journey through the intricate world of gold, let us remember that history can provide valuable lessons, but it's our analysis of the present and our understanding of the ever evolving dynamics of the global economy that will shape our future perceptions of this precious metal. In conclusion, understanding the historical patterns and dynamics of gold during crisis can provide valuable perspectives. Gold's role as a safe haven asset and insurance against economic uncertainty has been demonstrated time and time again. However, as with any investment, it is crucial to conduct throughout thorough analysis, considering multiple factors and exercising caution when making investment decisions. You let me know what you think. Please subscribe and follow. Have a good day.